Imagine buying a $30,000 car, only to find out it costs less to build than your kitchen appliances. Now picture the company selling it. BYD outselling Tesla in China and claiming to lead the global EV revolution. But here's the uncomfortable twist. The math behind BYD's success looks more like a magician's trick than a business breakthrough. If you think BYD is the next Tesla, you're missing the story Wall Street refuses to tell. Because buried in the numbers is a risk no one's talking about, a risk that could flip the entire EV industry upside down. Stick around, because what you learn here could change how you think about every electric car and every dollar invested. Let's start with a number nobody ever questions: 3.02 million. That's how many cars BYD sold in 2023, almost doubling the year before. At first glance, it looks like a historic win for electric vehicles. But here's what most investors never realize. Over half those sales weren't pure electric cars at all. BYD's secret weapon: plug-in hybrids, cars that run on both gas and battery power. To Wall Street, those hybrids count as EV sales. To most drivers, it's just a gas car with a side hustle. So when BYD claims to be the world's top EV maker, the truth is cloudier than it looks. Now, let's talk about price, a word that triggers both car buyers and investors. BYD's strategy is simple: sell more cars by making them cheaper than anyone else. In China, you can buy a BYD Dolphin for less than a year's rent in a major city. That's not a typo. The starting price is under $17,000, brand new, batteries included. But the weird part is where those savings come from. It's not just cheaper labor or government subsidies. BYD makes its own batteries, chips, and even some of its machines. Vertical integration, taken to the extreme. But there's a catch. When you control every piece, you also eat every mistake. And that's where BYD's real bet starts to get dangerous. Because competing on price isn't just about winning customers, it's about surviving the world's most brutal price war. Last year, Tesla started slashing prices in China. BYD responded by cutting even deeper. On paper, that sounds great for drivers. But for BYD, it's a race to the bottom that can wipe out profits overnight. In fact, BYD's net profit margin is just 5.4%. That's less than Toyota, less than Ford, even less than McDonald's. So, how does the world's fastest-growing EV company make so little money per car? The answer? Volume hides 100 problems. BYD can crank out millions of cars, but every car sold at a loss or a razor-thin margin makes the next price cut more dangerous. And if you're thinking, but what about government subsidies? That lifeline is shrinking fast. China began slashing EV subsidies in 2022, and now BYD's on its own. That's forced BYD into an even riskier position: out-innovate or watch the cash burn up. Now, let's zoom out. Investors love to cite Warren Buffett, one of BYD's biggest early backers. Buffett's Berkshire Hathaway bought in back in 2008, when BYD was just a battery supplier. But here's what most people miss. Buffett has been quietly selling his stake since 2022. He's locked in massive profits, but he's also signaling that the easy money days may be over. So why is BYD still flying off the shelves while insiders cash out? It comes down to one thing: global ambition. BYD isn't just selling in China anymore. They're storming Europe, Latin America, even Australia. But the catch? Every new market is a minefield. Europe is eyeing tariffs on Chinese EVs, worried about unfair competition. Australia and Brazil have their own protectionist walls. And every step outside China means higher costs, more red tape. So if BYD can't make up for shrinking profits at home, its global gamble gets even riskier. But here's the plot twist. BYD isn't just a car company. They're betting the house on batteries, supplying not just their own EVs, but rivals like Toyota and Ford. If the EV price war gets too bloody, BYD's backup plan is to become the world's battery king. But the battery business is no golden ticket either. Competition is fierce, and margins are even thinner. So why does BYD keep doubling down? The answer is hidden in the fine print of every quarterly report: market share above all else. BYD is playing for dominance, not dollars, at least for now. But here's the dark side. Dominance at zero profit is just a fancier way of burning cash. And if the music stops, if demand drops or competitors cut even lower,
BYD's empire could evaporate in months.
But let's not forget the wild card, China's government. Beijing has every reason to keep BYD alive: jobs, prestige, and the race for global tech supremacy. But government support is a double-edged sword. It can prop up a business or turn it into a pawn. And if politics shift, BYD could suddenly find itself without a safety net. So what does all this mean for you, the investor, the driver, the curious outsider? It means that BYD is neither the next Tesla nor a get-rich-quick scam. It's something riskier, a hyper-efficient machine built to win market share, no matter the cost. If that gamble pays off, BYD could reshape the car industry and your financial future.
But if it fails, the fallout won't just hit China. It could shock the entire global market.
So before you buy the hype or the stock, ask yourself, are you betting on a business or just a brilliant illusion? Here's the bottom line. BYD's real risk isn't what you see on the sales charts. It's everything hidden underneath. So, is BYD a scam? No, but it's not the sure thing everyone thinks either. It's a high-wire act, one that could make history or go down as the world's most expensive magic trick. And if you want to know why Tesla is actually cheering for BYD's risky game, don't miss our next episode. But let's dig deeper. How does BYD actually make EVs so cheap, down to the nuts and bolts? Let's pop the hood. For starters, BYD's Blade battery is a game changer, thinner, safer, and cheaper to produce than the competition. Most rivals buy battery cells from giants like CATL or LG, adding a 15% markup before they even reach the assembly line. BYD skips the middleman, rolling out its own lithium iron phosphate cells, meaning they pocket that margin. Lithium iron phosphate isn't just cheap, it's more stable. BYD can pack batteries tighter, making cars safer and roomier. That's why you'll see BYD cars with more interior space, at the same price as a cramped rival. But the real twist? BYD's battery tech is actually licensing proof. Rivals can't just copy it overnight.
So if BYD's battery lead holds, they could supply rivals
or squeeze them out entirely. But here's the irony. Every innovation BYD makes to cut costs also makes them more vulnerable to swings in raw material prices. If lithium prices double overnight, like they did in 2022, BYD's whole cost advantage can evaporate faster than you can say supply chain crisis. And with China's recent export controls on graphite,
BYD's battery supply chain is suddenly a political football.
What most people miss, BYD's vertical empire is a house of cards if raw material prices go wild. Now, let's flip to the showrooms. Ever wonder why BYD showrooms are popping up everywhere, even in cities you've never heard of? That's because BYD floods new markets with demo cars and deep discounts, sometimes selling below cost, just to get a toehold. In Thailand, BYD's Atto 3 went from zero to the country's top EV in just 6 months, thanks to price cuts that stunned local dealers. But that playbook is risky. If local competitors retaliate, or if governments close the subsidy window, BYD can get stuck with unsold inventory. That happened in the UK last year. BYD's first batch of Tang SUVs sat on lots for months, losing value every day. The hidden cost? Inventory write-downs where profits disappear, not from a bad product, but from a misjudged launch. And that brings us to the real question. Can BYD's volume game work outside China? Or is it a mirage built on home court advantage? Let's talk about something nobody expects, the BYD brand. In China, BYD is everywhere. Taxis, buses, private cars. But in Europe, it's still a curiosity, not a status symbol. Brand is everything when you move upmarket. BMW and Mercedes can charge double just for the badge. BYD's big challenge: can they shift from being the cheap EV to a brand people aspire to own? If they can, margins could rise. If not, they're stuck in the discount aisle forever. But here's the kicker. Even Tesla struggled for years to earn prestige in Europe, despite first-mover advantage. So BYD's global domination isn't just about tech or price. It's about winning hearts as well as wallets. And in the end, the world's most valuable car companies sell dreams as much as they sell vehicles. So if you're betting on BYD, know you're betting on a brand that's still trying to invent itself under the world's brightest spotlight. And here's a final, overlooked twist: the technology transfer trap. BYD's expansion means more partnerships and joint ventures, sometimes sharing technology with local firms to win market access. But what happens when those partners become competitors, armed with BYD's secrets? It's a classic irony. The faster BYD grows, the more it risks teaching its rivals how to beat it. So, investors hoping for BYD to be the next Toyota should remember, Toyota's moat was built on secrets, not giveaways. Will BYD's open-handed strategy pay off, or will it come back to haunt them when the copycats arrive? That's the final risk no one's pricing in. The more the world learns BYD's tricks, the less magic is left.